Welcome, everyone. Um, in today's topic, um, we will emphasize on the basics of accounting. As you know, accounting is also known as a language of business. So, how it is, or how accounting is a language of business, because it talks about the company. It represents the company's position, how the company is running, how the company is doing, is reflected in the financial statements, in the reports that is prepared by the accountants. So in today's video, we will have a look on the fundamentals of accounting. So like why accounting, the different basic definitions of the elements like the assets, liabilities, owner's equity, revenues, expenses. What are these? And how we can record these. And different types of business organization has different kind of ways of recording and reporting financial statements, and also some ethical aspects, say, or accounting professional bodies, some very basic of these issues. So, what does an accountant do? What is accounting? Accounting is a process, a system, or a system of doing some activities. As it is stated here, accounting encompasses the information system that measures business activity, processes the data into reports, and communicates the results to the decision makers. So, three activities are stated here. These are the basics or basic or very fundamental activities of an accountant. So, what's happening in the organization? We have to measure it. How we measure it? We measure in terms of money, in monetary terms, right? In different currencies, right? It's maybe in pound sterling, it can be in dollars, or it can be in rupees, or it can be in taka, right? Or yen, something like this. So we measure. When we talk about financial accounting, we must measure the events or the incidents that happened in the organization to be eligible for recording in the books, in the books of accounts. So this is the first activity, and then we have to process the data, or the data that we generated from the incidents, from the events of the organization, the transaction that happened in the organization, and then we process those and prepare reports. So in the process, it's, though we are saying it is process, this process includes a number of activities. So we record the transaction in the primary books. This is what we call journal entry, the first step, primary records. And then we classify the primary records according to the nature of the accounts. This is what we call classification of the accounts, classifications of the transactions. And then we summarize the transaction that we classified. So we classify the transaction according to the nature, that is what in accounting we say ledgers. And then the ledgers, each and every ledger get a balance. So the ledgers has the debit amounts and credit amounts, two different sides, as we will discuss after. So what's the difference between debits and credit? That is the balance of a particular account. For example, if we say furniture account, so if we Furniture has some debits. If furniture increases, debit balance, right? Previous balance, and then increases and decreases because of sales or depreciations. And then what remains? What's the ending balance? What's the remaining of furniture at the end of the period? What was at the beginning? What changes happened? And then what remains? So the balance end of the period, balance at the end of the period is represents what's the position of that particular account of particular asset or liability. And this balance is transferred to the summary accounts. So every ledger has a balance, either debit or credit, or may not have a balance. Some account may not have any balance. So debit and credit equals, so no balance, no balance. So if the ledgers has balance, those balances are transferred to the trial balance or the summary statement. That is the summarizing um, the events, summarizing the transaction. And then from this summary, we prepare the reports. That means all revenues and expenses are transferred or included in the income statement, assets, liabilities, owner's equity in the balance sheet, and we summarize the cash transaction in the cash flow statements, owner's equity related transaction in the owner's equity statement. So these kind of statements are prepared for the analysis of the organization's financial position. And then after analyzing, so analysis is the last practical or basic process of accounting. And then we communicate this information to the decision makers, to the related parties, to the stakeholders, the people who are involved or related to the business, to the organization. It may be a business organization, or it may be any other organization. It may be a government organization, or it can be an NGO, or it can be a government itself. So the people who are interested in the organization, related to the organization, are actually the users of accounting information. So it can be a person or individuals or businesses or investors, the people who invested in this organization, or can be creditors or government agencies, tax authorities, employees, labor organization, researchers, students. So they use this information for decision making. So for measuring or recording transaction in the books of accounts, we should know some definitions, some basic elements of these statements. So organization has some assets, as we know, some liabilities, some owner's equity. Organization earns something that we recognize as revenues. Organization spends something to run the business. This is what we call expenditure or expenses. So what are those? How we can identify that this is an asset? So asset, items of value owned by the business. So the ownership is with the business. Business is the owner of something, right? Is the asset. So sometimes we can say three characteristics of an asset. One, which you have ownership, from where you are expecting future benefits, right? And also this asset or this item has inherited or purchased or constructed by the organization before. So there is a previous incidents, it is owned by the organization, and from where organization expect future benefits. For example, a car. So you purchase the car, it's a previous incidents, and you are the owner, you are owning, you have the control over the car now, right? The business is owning the car, and from this car, organization is expecting future benefits. The organization will use it for future activity. So it's an asset. What is liability? Liability is that you actually, or the things that you actually owe to you. So for which you are obliged, you have obligation to pay. So the debt of the business, for example, the loan or creditors, payables, okay, are the liabilities. So that means what you are supposed to pay, right? So someone has some claims on the business, right? So the bank provided some loan to the business. So the bank has a claim on the resources, on the assets of the business. Owner's equity. So this is also a claim on the business, but this claim is from the owners, right? So if someone invested some money in the business, so they have some claim on the assets of the business. So owners, promoters, shareholders invested their shares in the business, right? So these are what we call owner's equity. This is also a liability, a kind of liability, or we can say this is an internal liability of the organization, of the business, of the enterprise. And generally, liabilities means external liabilities, but owner's equity is the internal liability. All right. So another example of asset is the people who owes us money. So someone has obligation to pay to us, right? For example, we sold something to any any person, to any organization. We sold something on account. They didn't pay us. So that means they will pay us in future. This is what we call the debtors or account receivable. So we will receive something in future. We will receive, right? So we sold something, that's the previous incident. We have a claim on someone, we are owning that asset from where we are expecting future benefits. We will get the benefit, we will receive cash or something else from another organization, another business in future. So these are also asset. And liability can be if someone sold something to you, if we purchase something from another organization. That means we have an obligation, we have some responsibility to pay to them, right? That is the creditors. So they have the creditors or the other person, other organization has claim on us, and we are obliged to pay, we are supposed to pay them in future, all right? So let's see next. So let's see an example. On, on the 29th of May, we purchased a motor vehicle for $20,000. So what are the accounts involved in this case? So as you see, we purchased a motor vehicle. So for 20,000, and it seems like we paid cash and we purchased motor vehicle. So motor vehicle came to the organization in and cash out, right? So cash out. So cash is a party. Cash is an account involved, and also we purchase vehicle, motor vehicle. So motor vehicle is an asset that came in. So motor vehicle came in, and cash, another asset, right, went out from the organization. What type of accounts are these? What type of accounts are these? So both are cash, both are asset. Apologies. Both are assets. Motor vehicle asset account, cash asset. But one asset increased and the other assets decreased. All right. Are there any other accounts involved in this case? So these are the two, basically two accounts, two parties, two elements involved in this transaction. All right. So math, assets minus liabilities equal to owner's equity. So this is what we call the accounting equation. It can be restated as assets equal. See, if you take liabilities to the other side of the equal sign, so it would be plus, right? Positive. So assets equal liabilities plus owner's equity. So that's the equation. So the other way, asset minus liability equals owner's equity. Okay, so asset is the total assets of the organization, from where if you decrease liabilities, external liabilities, then it is equals the claim of the shareholders or the owners remains, right? So what is the capital? Equal asset minus liability. Okay, or asset equal liabilities plus owner's equity. So total asset equal external liabilities plus internal liability. Okay, so what does an account keep track of? So there are two types of accounts that we need to keep track of. We need to record to evaluate the performance of the organization. One is the revenue, the other one is the expense. So revenues and expenses. What is revenues? Revenues usually means by operating the business, running the business, right? Or what's the purpose of the business? To sell products. What's the purpose of the business? To give services. So by doing this activity, main activity, what we receives, what comes in from these activities are revenues. All right, so it can be sales revenue, it can be interest revenue, it can be dividend revenue or rent revenue. So you have lots of resources, properties, rented revenues, right? You have lots of money, you are invested in different organizations, deposited in different banks, you will get interest revenues. If you sell products, you will get sales revenues. If you give services and receive money, it is service revenues. Okay, and in doing so, in running the business, by operating the business, if you need to spend some money for doing this business, doing these activities, to run this business, to operate this, right, to provide services, to produce products, what we spend, what we give, what we pay are expenses, right? So like can be petrol expense, can be telephone expense, electricity or office supplies, rent, wages, many taxes, right? Internal council taxes or different kind of can be insurance expenses, can be postage, right? Salary expenses, many expenses, so whatever we are supposed to pay to run, operate the business are expenses. So, for example, on 28th of May, we paid 300 rent. So two accounts are involved. What are those accounts? So we paid 300. That means we paid, so cash went out from the business and we paid rent, right? We paid for rent. As we said, if we pay something to run the business is an expense. So that is rent is an expense. These two accounts are involved here, right? We paid 300, so cash went out. Okay, it should be credited, and rent is an expense. Expense is debit if it increase. So these two accounts are involved. What type of accounts are they? So cash, as we know, we already learned cash is an asset account, but cash decrease here. That's why asset decrease will be credited, and rent is an expense account. Is a kind of nominal account, expense account, so it should be debited. Okay, now very basic, very basic. We will do further discussions in another video. So accounting profession, yeah, many people knows accounting is a well-known, well-recognized profession, and it has lots of opportunities throughout the globe. Particularly if you are a professional accountant, it is highly recognized, right? Each and every organization needs account, right? So there are different types of accountant, different kind of profession or category of services in accounting. You can do auditing, or you can do tax planning, you can or preparation and management consulting, or financial accountant, So many types of yeah jobs. So it can be internal accountant or it can be external accountant, right? So yeah, and each and every department, each government department, so each and every private organization has accounting because they need to record what are the transactions, what are the monetary affairs happens in the organization. So and if yes, any business graduates can be an accountant, but if you want to be a highly qualified accountant, it is preferable to have some professional qualifications like CA or CPA or IPA or SCCA. This kind of qualification is, if you get this kind of qualification, then you will get better payments, better salary, better position, right? So yeah, if you are business graduates, you can, and then after graduation or in the middle of the graduation, you can enroll yourself in any of the programs, and then you can complete your professional qualification, right? And can be hired by very highly paid or recognized corporations. Yeah, yeah. So um, in accounting regulations, is highly regulated profession. As you know, it deals with money, right? You have to deal with money, organizations, monetary aspects, right? So it is highly regulated. And these slides are actually made from Australian context. So as you can see, the examples are given. Australian Securities and Investment Commission is the public sector. Government is any country. Government is regulating the profession, right? The accountant has some responsibility given from the government, right? And also at the same time, if you work in a listed company, right? So the listed companies or the stock exchanges has some kind of Securities and Exchange Commissions has some kind of regulations, responsibilities provided on the accountants or accounting profession. And also from the accounting profession itself, accounting standard bodies has provided you standards, right? Some rules, regulations, guidance to perform your responsibility, to prepare the financial statement, to record the financial statement, measure the events or incidents. So how you can do it? You have to follow these rules and regulations and standards, right? In performing your responsibility. And also among these responsibilities, there are some basic principles that we are supposed to follow in recording and reporting financial statements. So, and these basic concepts actually regulates or actually represents what we should record, how we should record, how we should prepare the financial statements, something like this, right? So, entity concept is one of the basic concept in accounting. Entity concept represents each and every entity, organization, person, right, are independent, are separate. Okay. For example, you are an accountant of company A, right? So company A is an independent firm, independent organization for which you are preparing the reports. You are recording the transaction. So the owners of this organization and the organization itself are different. Even if you are working, if you work for a farm, for a sole proprietorship organization, single ownership organization. So the owner and the organization are not same, are two different entities. Okay, so you are recording the transaction for entity, not for its owners. If you work for an owner, if you prepare, record and prepare the statements for an owner, so that's a separate entity, but not for his own. So his organization and the owner himself are different entities. So if any money invested by the owner, that should be recorded as a separate transaction. in the books of accounts. If owner takes money from the business, should be recorded as well, right? If they take money for their own or personal use or family use. Accounting period concept is a concept that suggests us, that tells us to record the financial statements for a particular period. So we'll prepare the financial statements, or we will conduct these accounting cycle or activities for a particular period. Usually this is 1 year, but it can be a month, it can be a quarter, right? So it can be, and that's why you can see that there are some quarterly financial statements, right? Semi-annual financial statements or annual financial statements. So this is an accounting period, right? Accrual accounting. So there are two different types of accounting, you can say. Accrual is a different concept as well. It can be accrual accounting or cash accounting. In cash accounting, we will record only cash transaction, cash in, cash out. Okay, if anything happens, if we do anything, but there is no changes in cash, we will not record it. That is not part of accounting if we follow cash basis of accounting, cash accounting. But in accrual accounting, we will record all the transactions, all the monetary changes in the organization. If any events, any activity happened in the organization that is measurable in terms of money, right? Either it is cash, either it changes cash or not, whatever, we should record it. We will record each and every incident, measurable incidents in the books of accounts. If you sell something but you didn't receive money, sale on account, sale for credit, so credit sales, you will record it. If you purchase anything but you didn't pay, you will record it. Okay, so this is accrual accounting. You will record cash transaction as well as accrual transactions. This is accrual basis of accounting or accrual accounting. Going concern assumption or going concern concept is a concept that recognize that the organization will continue its operation for unlimited period of time. So that means organization will continue and continue and continue forever. This is what is the assumption, right? So that means it has implications in the financial statements, right? So that means if you think that you constructed a building, the building will give you service for 20 years. So that means the organization will continue even further, okay? But if you say, okay, organization will not continue, the organization will continue only for 5 years, that means you will get the benefits of the building for 5 years. Though the building will exist 20 years, but how long the business will exist? 5 years. So you will get the benefit. The organization will be benefited from this construction, from this building only for 5 years. So that's why, so we assume, or in case of recording transactions, the organization will continue for unlimited period of time, foreseeable period of time. So that means whatever the transaction, any long-term transaction, that should be considered. So the business will get the benefit from the building for 20 years. So it should be depreciated for 20 years because the organization will still exist afterwards. But if we think, no, organization will not exist, may not exist tomorrow, okay? So you can't depreciate the building for 20 years. You have to depreciate, you have to consider the whole cost of the building only for today, only for this year. If you consider that, no, the business may not exist next year. So the whole building cost should be recognized as an expenditure in the income statement in this year. But we don't do it. Why? Because we assume the organization will continue for unlimited period of time, and the building will give us benefits for 10 years or 20 years, and we depreciate accordingly. Okay. Yeah. Oh, these are the assumptions are explained here, as you can see. So yeah. So you can see them. Here. So yeah. Yes, as I mentioned before, different types of organization has slightly different um, patterns of activities, and that's why the requirements or the process of accounting slightly differs. Okay, so if it is a sole tradership organization, if it is a partnership organization, if it is a company, it differs. So we should know what are the nature of these organizations. Usually, the sole tradership organization has one owner, partnership has two or more owners, right? And if it is a company, usually there is no limit. Private company has 50, but if it is a public limited company, is unlimited. Life of the organization, if it is sole tradership, is limited, right? So if owners wants to close the business today, it can be closed today. Or if the owner dies, it can be closed. Or partnership, it is any partner deaths or choice of the owners, um, or the partners actually impact the ownership or the existence of the organization. But company exists for um, usually unlimited period of time. Okay, so um, then personal liability in case of in case of sole tradership, the whole liability is on the proprietor. In case of partnership, the whole liability is on the partners. But in case of company, the liability is limited to their investment, shareholders' investment. Accounting status is in case of proprietorship, it is separate from the proprietor. Since you have to record the accounting transactions or any incidents in the books of accounts only for the organization, not for the owners. In case of partnership, you will record for the partnership business, not for the partners. And the same, if it is a company, right, it is separate from the shareholders. You will record for the company, but not for the shareholders, right? Um, Ethics, right? As like as the other standards, rules, regulation, guidance. So it is suggested by the organization that it is expected the accountants, all accountants will um, abide by or follow this code of conducts. There are 5 code of conducts. Integrity, that means the accountant should be honest in doing jobs, activity. Objectivity should be impartial, unbiased. Accountant should be unbiased, should not bias to the organization, should not be biased to the organization, should not be biased to another party. All right. So it should be objective and fair. Professional competence and due care. So the accountant should update themselves, improve their capability, know latest rules, regulations, acts, accounting standards, right? So that they can do their job with competence, ability, and skills. Confidentiality in recording as an accountant, in preparing the financial statements in the organization, you will learn a lot of things from the organization. So um, you should, if it is a confidential information, right, you should not disclose to the other people or outsiders or external people, right? And professional behavior, you should behave professionally, right? Even if it is your brother's organization or the organization has interest of my brother, we should not consider my brother's interest or father's interest or other relatives' interest. I should behave professionally. I'm an accountant of that organization. I'm an independent auditor of that organization. I shouldn't care whose organization is it. All right. So, anything else? All right, that's all for today. Yeah, we learned about what is accounting, why accounting, and different definitions of assets, liabilities, owner's equity, revenues, expenses, and different concepts, and different professional accounting bodies, and yeah, some ethical code of conducts of the accountants. So that's all for today, and hopefully it is beneficial. I try to simplify the topic and make it easier for the people who actually and maybe very new to accounting. So yeah, let me know if I can help you in any way in creating new videos, and if it is beneficial for you, for your student, for your friends, you can refer, let them know and use my videos, yeah, and excel in your exam. Try to understand accounting.